This LOS is distinguished between public and private equity securities. Private versus public equity securities. Private equity securities are issued primarily to institutional investors in private placements and do not trade in secondary equity markets. The objective of private equity investing is to increase the ability of the company's management to focus on its operating activities for long-term value creation. The strategy is to take the private company public after certain profit and other benchmarks have been met. There are three primary types of private equity investments. 1. Venture capital. 2. Leveraged buyouts. And 3. Private investment in public equity. Venture capital investments provide seed or startup capital, early stage financing, or mezzanine financing to companies that are in the early stages of development and require additional capital for expansion. These funds are then used to finance the company's product development and growth. In a leveraged buyout, debt is used to buy all outstanding public equity. A management buyout, MBO, is a leveraged buyout by the current management of the company. And finally, private investment in public entity, PIPE, public firm raises equity capital through a private placement. Private versus public equity securities. So we'll look at some advantages and disadvantages of private equity compared to public equity. So some of the advantages are the reporting requirements are less, better able to focus on the long term, and potentially greater returns for investors if shares are sold through initial public offering, IPO. Disadvantages compared to public equity is that private equity is less liquid, it's not traded in public markets. It's less ability to raise capital, and finally, less disclosure, it may weaken governance. So we'll just finish this LOS with 3 practice questions. Here's the first one. Which of the following statements about private equity securities is incorrect? A, they cannot be sold on secondary markets. B, they have market-determined quoted prices. Or C, they are primarily issued to institutional investors. Okay, just got to be careful here because it says incorrect, so we're looking for the false. As I said, exam skills turn these into true or false questions. So I'm going to look at it. Private equity securities, they are primarily issued to institutional investors. That's true. They cannot be sold on secondary markets. That's true. That was one of the that's one of the characteristics. And then if we look, they have market-determined quoted prices. No, that's false. Private equity securities do not have market-determined quoted prices. So the correct answer is B. We're looking for the false because we're looking for the incorrect. Another quick practice question. Venture capital investments, A, can be publicly traded. B, do not require a long-term commitment of funds. Or C, provide mezzanine financing to early-stage companies. Okay, in this case, we're looking for the true. Again, turn these multiple choice into true and false. Venture capital investments can be publicly traded. No, that's false. We've talked about that. Do not require a long-term commitment of funds. No, that's false. One of the characteristics of venture capital is that you're committing your capital for a longer period of time while management has a chance to grow the company and then work on the exit strategy for the venture capitalist. Okay, so C, provide mezzanine financing to early stage companies. Yes, that's true. So the correct answer is C. Venture capital investments can be used to provide mezzanine financing to companies in their early stages of investment. True. And one last practice question to finish this LOS. Which of the following statements most accurately describes one difference between private and public equity firms? A, private equity firms are more focused on short-term results than public firms. B, private equity firms' regulatory investor relation operations are less costly than those of public firms. Or C, private equity firms are incentivized to be more open with investors about governance and compensation than public firms. Okay, in this case, we're looking for the most accurately described, so we're looking for the true. So private equity firms are more focused on short term than public. No, that's false. They can focus on the longer term. Private equity firms' regulatory investor relationships are less costly. Yeah, that's true. And private equity firms are incentivized to be more open with investors about governance and compensation. No, that's false. So B is correct. Regulatory and investor relations costs are lower for private equity firms than for public firms. There are no stock exchange, regulatory, or shareholder involvements with private equity, whereas for private firms, these costs can be high. And that's the last slide for this LOS. Thank you.